While some companies have been hitting all-time highs, UnitedHealth's stock performance this year has been a bit under the weather, with its stock price down 50% year-to-date versus the S&P near all-time highs and up 7% year-to-date. There are a bunch of videos from bulls saying that after such a drop, this is a must-buy now for its bounce back. Reasons I've heard is, the price is lower than it was 7 years ago in August 2018, or the PE is so cheap at only a 10, which just looking at a stock's past performance isn't ever a good sole reason to buy a stock. Fundamentally, people have also said UnitedHealthcare is too big to fail, as they are number 3 on the Fortune 500 with $400 billion in revenue and over 400,000 employees, more than Apple, Costco, or Alphabet. Or don't worry, 2026 will be a recovery year, as they can just raise their prices to get back to profit targets. Both of these may be true, however, not a valid reason for us to consider adding to our own portfolio. Stick around as we will quickly deep dive into how UnitedHealth makes money, their current situation, then we'll share our thoughts on if we will add this to our portfolio. Looking at UnitedHealth Group, and they're structured around 2 core businesses. First is UnitedHealthcare, which is the insurance side of the business. It makes money the way most insurance companies do. It collects monthly fees called premiums from its members, whether they're individuals, employers, or government programs like Medicare and Medicaid. They pool all this money together. Their goal is to minimize the total cost of care known as claims that they have to pay out. The difference between what they collect in premiums each month and what they pay out in medical claims administrative costs is their profit. The second core business is Optum, their services and technology side. Optum makes money by directly providing care, such as through doctor visits or physical therapy. Optum also operates a pharmacy benefits manager by negotiating with drug manufacturers for discounts that they can get paid a fee for when they pass these discounts on to health plan owners. The third and most profitable segment of Optum is their Insights division, which is a consultant side that helps doctors' offices understand billing, make businesses more efficient, or how to navigate new regulations. The key takeaway with UnitedHealth Group is it makes money through both their insurance side and by also providing services. Looking at UnitedHealth Group's financial situation since 2018, since that is when the stock was last at the same price, and revenue growth since then has been incredible. In 2025, it is expected to still grow revenue year over year by 10%, and consistently grew even during the COVID pandemic. Earnings per share, though, is expected to decline again from 2024 this year by 6% to earnings per share last seen in 2019. Despite this, UnitedHealth still has tons of cash generated, so increased their dividend again in June 2025, this time by 5%, and can continue to do so since it just has a payout ratio of 36%. Continued steady revenue growth, plus room for continued dividend increases for many years, seems great. And the earnings per share 6% decline year over year doesn't seem to warrant a 50% sell-off, so there must be more than the numbers are showing. And there is plenty of bad updates from UnitedHealth Group that started back in April 2025. In their first quarter earnings update, the company revised its full year 2025 earnings guidance downward, citing higher than expected medical costs. Then, in May 2025, the company stated it will suspend its 2025 financial outlook completely, and their CEO, Andrew Whitty, resigned, adding to investor uncertainty. In July, UnitedHealth Group confirmed a previously declined report that it is under investigation by the United States Department of Justice regarding Medicare billing. Then most recently, in their second quarter update, they terminated their chief financial officer and provided a significantly reduced forecast for 2025 earnings per share. This is tons of bad news that drove the stock down, but a lot of it's already been priced in for the 50% decline. So it is a fair question from the bull case of, has a stock been beat down enough that there's only opportunity to go up? Before we share our take, please make sure to read the full disclaimer in the notes below. We are not financial advisors, and anything we say should not be taken as formal advice or recommendation. Also, if you like content like this, please consider subscribing as we aim to release weekly content about innovative and long-term focused companies on this father and son podcast. Before passing it off to my dad John for why he is a no on adding UnitedHealth to our long-term educational portfolio, I will share the 2 reasons I'm a hard no on adding UnitedHealth. First, to address the short-term narrative that the price is so low that it is bound to go up, I just don't think that's true. Looking at the trailing price to earnings and where we're at now at around a 10, and is around the same levels as trading at around 2010 to 2013. Then, as you can see in 2024, the PE ratio just expanded to an absurd level before coming back down. Now, the counter argument is that UnitedHealth traded at a higher PE ratio between 2013 and 2020 of around 15, so why can't they get back to that? Well, during that period, UnitedHealth did focus on major innovative strategies and focused on substantial expansion of its higher profit margin, Optum segment. To command such a valuation, UnitedHealth will need to repivot and focus on innovation again, which leads to my second point. I don't believe they will. Charlie Munger once said the quote, "Show me the incentive, and I'll show you the outcome." And I believe that perfectly applies to UnitedHealth. To grow revenue, UnitedHealth already can consistently do that by just raising prices, which has successfully done as revenue has been consistently increased. There is no incentive for them to introduce any risk by growing revenue any other ways, as they have such a large customer base that is at their mercy. Earnings per share growth and margin compression is the biggest issue for the stock price to recover. They need to show in 2026 that they have a path to reignite growth here. The easiest and quickest way is not to introduce innovations, but rather can just increase premiums, meaning charge customers more and reject more claims. This easily helps them meet their goals, and their new CEO and new CFO can rejoice. This short-sightedness, though, may help the stock go up a little bit, but to become a long-term beater of the S&P, it needs to have PE expansion that it can maintain, and that is dependent on innovation. Not every healthcare company can be like Transmedics and literally save lives. But for example, we'd love to see UnitedHealth take advantage of all the data it has for predictive and personalized health management that truly helps individuals or pharmaceuticals make targeted treatments. Now, if a company is not going to be innovative, the second variable I look at for long-term growth is customer-centric. UnitedHealth is definitely not that, with a net promoter score of -12, meaning that customers are very unhappy. Now, before you say, of course, healthcare has low net promoter scores since people are upset if they get their claims denied, that isn't true. One Medical and USAA both have net promoter scores over 70, and in the hated banking sector, Nubank and Kospi have excelled due partly to their customer satisfaction obsession. People are getting older and getting sicker. There's only so much that premiums can be risen and claims denied, that improving customer satisfaction goes a long way to reducing market churn. But also, when members are satisfied with their care and have a good relationship with providers, they are more likely to seek medical care proactively, which leads to better health outcomes, but also lower medical costs spent by UnitedHealth. This win-win is good for society and a sustainable improvement to UnitedHealth's bottom line. With that said, John, what do you think?
Yes, as I look at the Bollinger Bands for UNH, it's been basically hugging between the lower Bollinger Band and middle Bollinger Band for about almost 6 weeks now, approximately 6 weeks now. So for it to even get to the middle Bollinger Band, that'd be around 270 as of now, as you can see. So looking at the Bollinger Band, it doesn't look promising for a buy for me. So as for the Bollinger Band, I would not buy it. That's my thoughts on the Bollinger Band. Looking at the 200-day and 50-day moving average, the 200-day moving average is sloping downward. It's the red line. The 50-day is sloping downward. It's the blue line. And as you can see, it hasn't even been hitting the 50-day for a while now. So and the 50-day is it's still below that, and the 50 days below the 200 days. So that's generally speaking not good for the short term. It's bearish, and also the price is way below the 200-day, which is also bearish. Looking at the 200-day and 50 days. So looking at this, I'm also a no with respect to UNH.
Thank you, John. So overall, both my dad and I are not interested in adding UnitedHealth Group to our long-term focused portfolio. Similar to Berkshire Hathaway, the stock will likely be higher than it is now, driven by earnings growth recovery, plus its dividend growth, which will be a nice win. However, we believe this will be done by short-term catalysts. Without a long-term focus on innovation or customer satisfaction, we do not believe that this can beat the returns of the S&P 500. John had also evaluated the technicals, the Bollinger and the moving average, and there isn't a trend that shows a broad recovery. I think the only logic right now that seems good is it's gone down so much so fast, so something's bound to go up. But from a trend and the moving averages, I think John would also like to see some baseline support as well. Thank you for watching. If you enjoyed content like this, please consider liking, commenting, or subscribing as we aim to release weekly videos about long-term focused, innovative companies on this father and son podcast.